Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Alrighty, welcome to the Smart Investing Show. I'm your host today, Chase Wilsey. No Brent Wilsey today, but no worries. Still got the show. Almost didn't. Expecting a baby this week, sometime soon. So we almost had to cancel the show, but baby is not here yet. So we have the Smart Investing Show today. And with me today is my co-host is Harrison Johnson. He's our financial planner. So excited to have him as part of the show. How you doing today, Harrison?
I'm doing well. I'm very surprised that we're here because I thought for sure Jaylee would be having her baby right now.
I thought we were going to have a Memorial Day baby, but we didn't. So we got a lot to talk about. We're going to talk about first-time homebuyers. They hit a record low actually in 2024. We'll talk a little bit more about the real estate market. We'll also talk about, is Bitcoin coming to your 401k? And then lastly, inflation. I thought we'd be done talking about inflation, but it's still prominent. We're still going to talk about inflation continuing to cool. Got some numbers there on the Fed's reading called PCE. Companies we're going to look at today includes Regeneron Pharmaceuticals. We're also going to look at Intuit, Target, and Toll Brothers. And then Harrison's topic in the second part of the show, we're going to talk about what is an accredited investor and probably how it impacts you, I'd assume.
Yeah, I'm looking forward to it.
Well, cool. Well, let's jump into it so we can actually get through some good information here. We're going to talk about here first-time homebuyers. They hit a record low, and I got to say, I'm not overly surprised by this, considering that the high cost of housing and now higher interest rates, people are trying to get their first home, and that dropped to a record low around 23% in 2024. There's no denying it. It's hard. It seems like, obviously, mortgage rates went from sub 3, we'll call it, to now, I'm going to say 7-8%. Mm-hmm. Plus, home prices did not go down. Mm-hmm. So now the affordability of those homes has even become more problematic.
Yeah, and these numbers that you're looking at are national numbers, but a lot of people that listen to us are in the California area, and obviously it's a lot more difficult here. The way that the state of California is set up for first-time home buyers, it's really stacked against you with the property taxes that you have to pay, the insurance that you have to pay, the high cost of living, the high purchase price of the homes, the high interest rates that you're dealing with. So, across the board, any metric you look at, home ownership, especially getting into that house, is expensive. And when you look at, how much real estate has appreciated in the past, the people that are buying the homes are the people that have had homes before. So that delta or that discrepancy between people with homes and without, canceling out first-time home buyers is just making it more difficult.
Yeah, it's really become challenging. And I was somewhat blown away by these stats, but the average age of the first-time home buyer has now increased 10 years over the historical average to 38 years old. The median income is now $97,000, and the first-time home buyers are coming up with an average down payment of 9% of the value of the home. So even with older home buyers, first-time home buyers, more income, you're still not even getting to a 20% level for that down payment. It's a challenge.
Yeah, and I think as far as the down payment goes, I don't have the number in front of me, but the average down payment I don't think has ever been 20% or even close to that. But, again, these are national numbers. So in the state of California, it's probably older and higher level of income to get into this. But average home buyer, almost 40 years old and, making $100,000 a year in median income. That's a lot different than what it's used to be in the past.
Yeah, and as you said, it's really interesting to kind of see the fact that home equity's gone up so much. So then people that are able to buy homes, well, they're able to capitalize on that home equity. But if you didn't have a home, you didn't get that increase in home equity. So it's really challenging to enter the market. And we can talk about this probably a little bit more later here, but I think unfortunately you've kind of missed the boat. You're not going to have, I think, a repeat of what happened really from about 2020 to 2025. I don't think you're going to see that same type of price appreciation from 2025 to 2030.
And a lot of that appreciation was, 2020 to 2022.
Yeah.
Since then it's been a lot slowed, but you're right. I don't think we're going to see that type of appreciation unless, I don't think we're getting another COVID or something crazy like that.
I hope not.
And, looking at the the age here, 38 years old, I believe just the experience that we've worked, I mean, we have a few hundred clients. The people who are buying homes that are younger almost exclusively are getting help from their parents who did have appreciated real estate, and they're using that in one way or another, meaning they have other assets that they're okay parting with because they have so much appreciation, or maybe they moved and they're accessing some of that equity. Now they can help out their kids. I don't want to say young kids because they're fully adult kids many times with their own kids at that point. But so that discrepancy between having homes versus having not is, it's wide, and it's getting wider.
Yeah, and I mean, it is an interesting point. And I'd say, especially here in California, to that point of needing to help your kids, I'd say we have a lot of friends, obviously, in Arizona, since we both went to school in Arizona. They've been able to kind of afford homes there because they're a lot cheaper than they are here. But here in California, yeah, I mean, even if you have a $1 million home, which is pretty standard in San Diego County, I mean, you need $100,000. I mean, that's hard to come across.
Yeah, my mother-in-law has been trying to get a hold of me recently because she's trying to find ways to help my brother-in-law buying a house, and he's, I think, 38 years old, actually.
Hey, he'll be right in line with the median first-time home buyer then. And I was going to say, too, one other thing that kind of concerns me, I guess, on further price appreciation, many of these young buyers that are using these FHA loans, which do require a very small down payment, and according to research, roughly 30% of all FHA mortgages have a debt service ratio of over 50%. This means more than half of these buyers' incomes is going towards servicing debt. And this is what concerns me from a price appreciation standpoint is you can't go from, I'm going to say 30% debt service ratio. I'm not sure what it was in the past to 50%. You're not going to go from 50 to 70 to 80. I mean, you got to live, you got to do other things. And it's going to make it hard on some of these people to go on vacation, to, maybe buy a new car. There's a lot of challenges within the fact that the debt service ratio is quite that high. Now you can buckle down and, you'll be fine, I think, long term. But it is, I think, bringing about its own challenges. And that is one reason I really see a cap on how much further housing can appreciate.
Well, as far as who can afford that.
Yeah.
And, looking at that ratio, there is only so far you can go because the way that that's calculated, it's based on gross income. So your gross income, how much of that, in many cases now over 50% of that gross income is going to pay for housing, the debt service of it. So, you have your gross income, you pay your taxes, and then you pay your housing, and that does not leave very much less. And so even with people of higher levels of income, they're paying more tax. So, it still is difficult no matter which way that you look at it. And as far as that ratio, if you listen to Dave Ramsey, for example, his thing is, you want
no debt.
But if you are going to have debt, 20% down with a 15-year mortgage, and that mortgage has to be less than, I think, a quarter of your income, of your take-home income, which means, no one's buying a house in California.
No, I think the Dave Ramsey philosophy, I don't think works for people in San Diego that are in their early 30s.
No.
You have to make millions of dollars to be able to subscribe to that philosophy.
And eat rice and beans.
Yeah, exactly. And I was going to say one thing that is, I'm going to say somewhat positive here for, people that are wanting to enter the market is, inventory has been so tight in housing for, several years now. We did actually see 1.45 million homes for sale at the end of April, which at the current sales pace represents about a 4.4 month supply. And also, too, inventory did jump by about 9% compared to the prior month. So we are seeing more homes come on the market. And it was actually the highest supply that we've seen in about 5 years. So, we are seeing more homes come on. Sales, on the other hand, have been declining somewhat. People are a little bit slower to move, which what should then happen is inventory continues to rise. That should then, I don't think, and we've talked about this a lot, I don't see a crash in housing prices. I want to be very, people are like, oh, you're anti-real estate. I'm not anti-real estate. I just bought a house. I look at it and saying, housing prices, I don't think, as we said, are going to appreciate by 8% a year over the next 5-10 years. I also don't see them falling 10, 15, 20%. I think there is that floor in there because, as you said, you have older buyers that can step in, help their kids. You have a lot of people on the sideline. So the housing market, I think, is more going to be a stall out over the next 5 to 10 years, depending on how much appreciation we see. But there is, I think, some hope for allowing incomes to kind of catch back up to housing and not having the huge appreciation that we've seen. So if you're a first-time home buyer, you're waiting on the sidelines, don't become impatient. Get yourself in a bad situation. Buy a home that you hate, and then you move out 3 years later. Again, that patience, I think, is still very important here because I think the housing market will continue to normalize over the next 2, 3, 4 years.
And some of that, I think, is going to, definitely going to be influenced by what interest rates do. Interest rates have been at this level for quite a while now. And so the affordability, home prices haven't changed too much in the last couple of years. Interest rates haven't changed too much in the last couple of years. So there's this pent-up demand that's accruing. But one thing I tell people that are renting is not necessarily a bad thing. People think that, I'm a renter, I'm a failure. We rented for a whole long time. And in many cases, from a financial perspective, renting is okay. If your rent is $2,000 a month, but if you buy a house, it's going to be $6,000 a month. Well, if you're renting and if you're saving that delta of $4,000 into something, in many cases that might be good, especially if the home value doesn't appreciate. Because when you buy a house, to make home ownership better than renting, because of the extra money you're putting into it, you need appreciation to account for that extra cash flow that you're putting into it. So renting's not necessarily a bad thing. Don't rush into something that you're not ready for because, over the next, even the rest of this year and into next year, I don't see home prices appreciating a ton. I don't see interest rates falling off a cliff. So affordability, I don't think is really going to change too much over the next, 12 months or so.
Yeah, we got to move on here, but I think the way to sum it up is I think renting isn't that bad. Buying a home isn't that bad. It really just depends on your situation, kind of where you're at. Both make sense depending on, again, what you're looking for and what you personally need. But with that, let's move on here. Is Bitcoin coming to your 401k? And, there's no secret here. I think people that listen to the Smart Investing Show know that we don't like Bitcoin.
What do you mean we? I love it.
No, you don't. But, it's been several reasons we don't like Bitcoin. Fraud, illicit activity. Those are really the primary use cases for it at the end of the day. And then the fact that I look at Bitcoin, there's no real way to derive an intrinsic value from it since there's no earnings, there's no cash flow, and frankly, there's not really anything backing the asset class of cryptocurrencies as a whole.
That's the thing that gets me. Fraud is kind of a, subjective type of thing, or, but with Bitcoin or any other type of cryptocurrency, is Bitcoin worth $100,000 a coin? Is it worth 50? Is it worth $1 million? You don't know because there's no cash flow, there's no metrics, there's no valuation to look at. At the end of the day, the value of Bitcoin is going to be based on who is buying it and who is selling it. If more people are buying it, price is going to go up. Stocks do that same thing too, but a stock is a piece of a business. That business has earnings, it has dividends, it has cash flow. So you can look at numbers, which with crypto, there's not a lot to look at. Is it a technology? Is it a currency? Is it an investment? Who knows what it is? So the other thing I'll say to that is there are people who have made money in it, but it's not like that's the only thing that you can invest in to make money. It's like, oh, I'm so smart. I put $1,000 into Bitcoin and now I have $5,000. Okay, what are you going to do with $5,000? You're not buying a house anywhere. And there's been other assets that have appreciated, and so you can invest in other assets that you do understand, that you can value, that you can get at good prices.
You know what I find so ironic with cryptocurrency and Bitcoin is people generally that buy Bitcoin are worried about the U.S. dollar. And they say, oh, well, what is the U.S. dollar backed by? And it's backed by the full faith and of the U.S. government, which some people are like, oh, yeah, I don't trust that. But I'll tell you, ironically, what is backing Bitcoin? It's just people's faith in Bitcoin. To me, that's far worse than the U.S. government that is a taxing entity. You have all of these people making all this money in the U.S. They have that ability to tax people and produce income. Bitcoin doesn't even have that. You have full faith in essentially nothing at the end of the day.
And the dollar is based on the full faith of the government because the government has ability to tax, and the government has largest military in the world, so it has the power to reinforce that and everything. But with that said, we're also not saying have all of your money in dollars. You shouldn't have everything in cash.
It's not
anyway.
A like-for-like comparison.
Yeah, exactly. So, we want to take dollars and we want to buy other assets. So we're not comparing Bitcoin to dollars. We're comparing Bitcoin to stocks or real estate or, anything else.
Realistically, we have this conversation quite frequently. The only thing that I would invest in is stocks or real estate. Both produce cash flow. Both are good assets that I think have longevity to them because of what the assets are. Then the remaining amount of your cash should probably sit in a checking account or a high yield savings account if you have a short-term goal. Outside of that, I don't think there's any other need for investing in anything else because I only want assets to produce cash flow.
Yeah. Yeah,
Plain and
exactly.
simple.
I mean, it doesn't have to be more complicated than it is.
Yeah, I mean, it really doesn't. And the reason I was kind of intrigued by this Bitcoin piece was that the current Labor Department actually removed a language that cautioned employers to exercise extreme care before making crypto and related investments available to their workers. They cited serious concerns about the prudence of exposing investors' retirement savings to crypto given significant risks of fraud, theft, and loss. So now this Trump administration, they've been, really pro-crypto. They want to kind of title themselves as that. So they are doing these little things that seem to be making it more mainstream, essentially. And this was a step that potentially opens the door for more crypto and 401k plans.
Which that could potentially, that would increase the supply of people who would be putting dollars into there, which could cause the value to increase. But it could also make it more volatile if people are buying and selling. And I don't know if anybody's asking or how many people are asking to have Bitcoin in their 401ks, but the average person who has a 401k is an idiot. Not everybody. Most of the people who probably listen to this show
idiot
are
from
not
an
in that.
investing standpoint.
Well, what I mean is we have some 401ks for companies that we manage, and we do that for the employer's benefit because they're the one that sets it up and they're the ones that actually receive the benefit because their employees generally, they'll quit or get fired or whatever, and they'll have a few $1,000s.
They don't even do
in
anything.
it.
Yeah, it just sits in a default option.
Or they're like, I want the money. It's like, okay, federal taxes, state taxes, federal penalties, state penalties. So over 50% of it's going to go away. Yeah,
Yeah,
fine.
sounds good.
Send me a check.
Yeah, send me the check.
Okay. I'm going to go buy some Bitcoin.
Yeah. I mean, we'll see what happens, but I still don't see this happening in 401ks because you have to understand that within those 401k plans, it is governed by ERISA, which does bestow a fiduciary duty on employers and company officials overseeing 401k investments. And that means legally employers must put the best interests of 401k investors first and act prudently when choosing which investments to offer or not to offer. And I just see this as a huge potential for lawsuits and cryptocurrencies if all of a sudden, let's say cryptos, because they are extremely volatile, they crash 70, 80, 90%. You put all of your money in Bitcoin because you believed in Bitcoin. What are you going to do? Probably going to sue your employer.
I think Bitcoin will be a part of 401ks. I think it will happen because, there's that movement that's going toward it, whether or not that's a good thing, but I think that will happen. But I'm going to talk about this a little bit as far as the fiduciary aspect of it goes. Fiduciary at the end of the day is subjective. If you think that something is in somebody's best interest, in many cases you can make that argument. Not always, but it's not like a black and white thing. So there might be lawsuits, but I would venture to guess that at some point cryptocurrency will be a part of retirement plans, ERISA, 401k plans.
Yeah, I don't think it should, and I think it's going to be a very slow adoption, though. You've already seen some plans, I believe, are offering it, but I just don't see a lot of employers. We talk to people all the time. There's a very small subset of people that even still believe in crypto. So you as an employer have to have that confidence, and now allowing that into your fund lineup, I still think mass adoption of this in 401k plans is at least years away because there's just not that longevity of it as an asset class. But could be wrong. We'll see. I hope that doesn't happen because I think people could get hurt. And I think the 401k is the best way. As much as I hate mutual funds generally, you really can't lose in your 401k long term. If you invest in a good mutual fund for 15, 20, 30 years, you're going to be able to retire just fine.
Well, with that consistent buying into it, no matter what, some funds are obviously better than others that you have access to in your 401k, and some 401k plans have a different list of funds, but any one of them with enough contributions into it should have a positive return over time.
Yeah, and I think that is the way that 401k should operate, and people might be saying, oh, but I could do so much better outside of it, but I think as a whole for society, I do believe having good, stable, diversified mutual funds is going to be probably the safest way to ensure success for people's retirement.
Yeah.
Especially without a pension system that we used to have.
I mean, when you look at the TSP, for example, the options inside of the TSP are so
realistically
simple.
6.
Yeah.
Right?
There's a bunch
5
of
or 6.
There's a bunch of target date funds. There's cash. There's the S&P 500. There's a small cap, and there's an international.
So there's a bond.
And there's a bond one. But I mean, it again doesn't need to be complicated. And I mean, we see people all the time that come in here and they have TSPs, $1 million, $2 million, and it's not like they were maxing it out every year for 40 years. They were just putting whatever they were into it, and it grew.
Yeah. So I don't know. I mean, we'll have to see. Again, long story short, just not big on Bitcoin. I think 401k should be a good asset for people long term, and I don't think Bitcoin should be part of that asset for those people as they retire. Last thing to talk about here in terms of the topics, we're going to look at the inflation report. Shows continued progress. The PCE, which is what the Federal Reserve really likes to look at here in terms of inflation, actually showed an annual increase of just 2.1%, while core PCE, which excludes food and energy, showed a gain of 2.5%. Both results were 0.1% below their respective estimates. And the big thing here is we've moved, I'm going to say, quite close to the Fed's target now of about 2%.
And one thing that a lot of people have trouble understanding with this is, we're getting closer to that number, but that doesn't mean prices have gone down. It just means the rate at which prices are increasing has slowed. So people are like, oh, I used to be able to buy this and, it was so cheap. When is that going to happen again? Well, it's never going to happen again. But
deflation is bad for the economy.
That's not going to happen. That's not what we necessarily want. That's also, again, why you don't want to have all your money in dollars, because with inflation, dollars are the only thing that's really losing value. Everything else is appreciating with it.
Yeah. So, I mean, we'll kind of see what happens here with inflation, because obviously April, this is what the PCE number was for. That was kind of the beginning of tariffs, right? So, I mean, now as we get into May, June, July, that is when you'll actually really, I think, start to see what companies are deciding to do with these tariff rates. And I was kind of interested by this. There's an economist from Pantheon Macroeconomics. He said he believed that the core PCE would peak later this year between 3 and 3.5% if the current mix of tariffs remained in place. And I continue to believe it's going to be difficult to actually really estimate the impact of tariffs, because there are so many intricacies within the supply chain. We've talked a lot about that on the show. So I'm almost like, I don't even want to try and forecast it, because it's going to be so complicated in terms of what that will be. I do think it's not going to be as bad as some people worry about. I saw this and it just drives me crazy. The University of Michigan Consumer Sentiment survey said the 1-year inflation rate now by people on the survey, 6.6%. I don't see that happening. This guy, I think the 3.5%, I think that's definitely very possible. But even with a PCE around 3%, I don't see that as being a bad thing for the economy.
Well, I think, it's impossible to predict what's going to happen with tariffs. It's happening. There's changes every single day depending on what the administration is doing and what different courts are doing and judges are doing, what other countries are doing. So there's constant change in that. And then we really don't know how long that's going to go on. So the raise in the PCE or the raise of inflation, I think, has a big influence on how long these tariffs last, which I don't think anybody intends them, including President Trump, for these tariffs to be a perpetual thing. It's more of a bargaining chip.
I don't know. I mean, it seems almost like that 10% baseline, he's kind of intrigued as having that on as a permanent tax. I mean, we'll see.
He
I don't know.
changes his mind all the time.
He
though,
does.
So.
And again, he always says it's the art of the deal, the negotiation tactic. You don't really want other people to know what your ultimate plan is.
Right.
So, I mean, we'll have to see. But if it even stayed on as a 10% level, I don't think that's going to cause big problems in inflation. I still am looking for the Federal Reserve to maybe cut rates maybe 2 times this year, and then maybe cutting rates even further next year, because I don't think this is going to cause ongoing inflation, and we can continue to push towards that 2% level perhaps next year, which should allow us to lower interest rates, which I think would be, of course, good for the economy long term.
Yeah. And I think as far as those interest rates cut, if that does happen, if we see 2 cuts, for example, I think that's definitely going to be in the later part of the year, because the Fed has just said, we want to look at the data, we want to see what happens. So Powell is, he definitely doesn't want to get ahead of anything. Yeah.
So with that, I want to jump into a company real quick. We're running short on time. So I'm going to get into the first company. We're going to look at Regeneron Pharmaceuticals. And this company, interesting. I mean, they fell about 19% on Friday. Shares of the company dropped because of inconsistent results from late-stage trials for its respiratory drug. This would always gets me, Itepekimab, which is developed with Sanofi. I'd be very curious, of course, how much of that company's performance, that stock performance, was going to be reliant on that drug, because that's a huge hit to the stock price. So thought it'd be interesting to look at those numbers here. We're going to start with the valuation ratios for Regeneron. The price to earnings ratio is about 12.5. So, I mean, that's pretty attractive against an industry that's not material. Price to sales at 4, below the industry at 7. Price to tangible book value is 1.9, also below the industry average. And price to cash flow of 14.2, nothing there for the industry average, but I'm going to say that's a decent price to cash flow ratio. I look at the estimated earnings growth going forward. That's about 7.1%, gives us a PEG ratio of 2.4. So, I mean, again, the valuations are very strong on this company. I'd be very curious, though, to see if that 5-year estimated growth rate does decline now with the concerns over this respiratory drug that did not have a strong trial. You do get a dividend yield here. I'm not going to say much. The dividend yield is 0.7%. Company only uses about 2.1% of their earnings to pay that out. Not sure why they even pay a dividend at that point.
I think that's so funny.
They did buy back a decent amount of stock, though. They bought back about 6% of all shares outstanding over the last 12 months, so they do have that cash flow to return to shareholders. Balance sheet, I mean, very clean, almost too clean. Current ratio here, 4.9, so tons of liquidity for the company. Debt to equity is 0.1, so very little debt on the balance sheet. Strong profit margin of 31.9%. Return on equity is 15.3. Return on invested capital about 14. I mean, numbers are looking, I'm going to say, pretty darn good here for, again, Regeneron. Again, the current price, it's $490.28. 52-week high, well, it's $1,211.20. So it's been absolutely crushed, essentially down, over 50%. And the 52-week low, it actually did hit that on Friday. See the year-to-date return, it is down about 31%. Over the last 1 year, down 49%. The 3-year return, down 29%. I mean, this stock has definitely struggled over time. Looking forward, though, I mean, this is where it kind of gets interesting. You go out to December 2026 to see estimated earnings per share here of $40.38. It gives us a target sell price of $670.31. So if I look at, again, that current price for Regeneron, it's now around $490. I mean, that's an estimated growth rate here of about 37%. So it is a good value. You just would want to understand, what are their drugs and how impactful was that drug that had some issues? Because this could have been an overreaction, and I'm going to say a buying opportunity within Regeneron, or it could have fallen for a reason.
How many analysts are looking at that earnings number?
It looks like there's about 24 analysts, so it's a pretty strong number.
What's the range of that? Because it seems like these biotech companies always have potentially a big range depending on what drugs hit and what don't.
Yeah, so range, it is a little bit high of a range, 3156 to 5366. And again, the big thing I want to understand is, would this drug now be impactful on those estimates as well? I'd maybe give it a week or two to let this data settle, and then maybe look at this company as a potential option. But we'll take a quick break here, and when you get back, we're going to talk about the accredited investor, what that means, how it impacts you, and we've got a few other companies we want to take a closer look at, see if it's buy, sell, or hold based off the numbers we see here. Alrighty, welcome back to the second half of the Smart Investing Show. As promised, we're going to start off here with Harrison's financial planning topic of the week. We're going to talk about what is an accredited investor, and essentially what does that mean to you as an investor. So I'll give you the floor here, Harrison, kind of probably chime in with some questions and comments around what you're talking about.
So, I mean, the technical definition to be an accredited investor, you can either qualify based on your income or your assets. So it's somebody who has, as a single person, at least, or by themselves, $200,000 a year in income, or $300,000 with a spouse, or your net worth is over $1 million, not including the equity that you have in your house. So if you are that, you're technically, or you can be considered an accredited investor.
And that includes retirement accounts, I presume.
Yeah. So basically investable assets in excess of $1 million. So what that means is you have access to private investments, so securities that are not registered with the SEC, private REITs, private equity, hedge funds, things like that. And a lot of times people get attracted to those because they have potentially higher rates of return, but they also, I mean, being unregistered, they have much higher degrees of risk, whether that's because they are illiquid, whether that's because they are not very transparent because they don't have to disclose as much information. And in many cases, you have the potential to lose everything that you invest in. So maybe higher returns, but definitely a much larger degree of risk. However, that doesn't mean that there's fiduciary advisors out there that don't sell them. In many cases, there are fiduciaries who offer these products, which is always kind of interesting because, I mean, on the fiduciary standpoint, just because somebody is a fiduciary, that doesn't necessarily mean that, you don't have anything to worry about.
Yeah.
As I mentioned earlier in the show, I mean, they're being a fiduciary or saying that you have someone's best interest in mind is subjective at best. So, like we're fiduciaries, but there's also different capacities that you can operate as a fiduciary. So Chase and Brent, you guys are fiduciaries because you're registered with the SEC, you're registered investment advisors. So when you are giving investment advice, which when you're managing a portfolio, when you're choosing what to buy and what to sell, that's investment advice that you are providing a service for. You're acting as a fiduciary.
Yeah.
I'm a fiduciary because I'm a CFP, and all I do is engage in financial planning with people, and when I am giving advice in that regard, I'm acting as a fiduciary. So there's a lot of different ways that you can act as a fiduciary, but there's also advisors out there that say they are a fiduciary, but they're not acting as a fiduciary when they're making a recommendation or selling something. So that's a couple things to keep in mind. Again, even if they are acting as a fiduciary, that doesn't mean that's the right thing to do. And then in many cases, if they are acting as a fiduciary, they might not be at that time. So back to the accredited investor, again, you have access to these things, but just because you have access to them doesn't mean it's something that you should, strive to invest in or strive to, I don't want to say take advantage of, but because we have people that are like, oh, well, now my portfolio is this large. Now I'm an accredited investor. So now I need to, do something a little bit different. Not necessarily. You never have too much money to, lose money. So
I think it's a great sales tactic, quite frankly. People like to feel special. It's like, oh, I'm going to sell you this private REIT because you're special. Mm-hmm. You're an accredited investor. And you're like, ooh, that means other people don't have access to it? It must be good, right?
Well, and I'll say this. Chase and I and Brent, we are on paper accredited investors, so it's not like we're jealous because we're not a part of the members only club. I mean, we fall into that as well, but we don't have any private investments or anything that we personally invest in. We don't recommend that people do that either because we have just seen so many cases where people have lost a lot of money, lost everything, or they don't even know how much money they've lost because they can't get access to it.
Yeah, and it could be, there's some I've seen where it's 15 years ago, and they're supposed to have an exit point 10 years ago, and it never happened. And it's awful. I would never recommend this to people. And I forget, there's a saying out there, and I forget who said it, but it's keep it simple, stupid. I don't know where that came from, but that is my philosophy when it comes to investing. We talked about that earlier in the show. Real estate, stocks, cash. That's it.
Simple. Again, now, in choosing which of those different things to buy, like which stocks, which real estate, all of that, has its own nuances and complications. But the point is, you don't have to go and rewrite the book. You don't have to reinvent the wheel and say, okay, well, now I have a certain amount of money. Now I'm going to do something different over here. Buying good companies, it works, and it's always worked, and it's probably going to continue to keep on working. Yeah,
and I loved the point you brought out about the fiduciary status. And I've had issues with the fiduciary status for years. And what I mean by that is, looking for a fiduciary is not a bad first step. I'm not going to say, oh, you shouldn't work with a fiduciary. Yeah, we're fiduciaries. I think that is a good first step. But as you said, it now needs to go a step beyond that, because just because somebody's a fiduciary doesn't mean they have the same investment philosophy. Ultimately, you want to find somebody, if you're looking for somebody to hire to manage your money, that you understand and you agree with their investment philosophy. Because I'll tell you, we differ with so many other fiduciaries in terms of how we would do things.
Yeah, we talked about it a lot. We don't like annuities. We don't like permanent life insurance. We don't like private investments. There's plenty of fiduciaries out there that do. And if they can make the case that really is in your best interest because of X, Y, and Z, especially on the case of the private investment, since it's unregistered, you have very little recourse if something does go wrong.
And I know we had a client, and I don't know the validity behind this, but the guy said he was a fiduciary, and he was recommending an annuity, but he was recommending to take a surrender charge on an annuity because the new annuity had a bonus on it. And he's like, I would never make that recommendation, but this guy was supposedly a fiduciary.
Well, I looked into it. So that guy was a Series 65 license, so an investment advisor. But in that context, I don't think that's in the realm of investment advice, going from one fixed annuity to another. I don't think that constitutes investment advice. So in that regard, I mean, he wasn't a CFP, so he wasn't any financial planning things related. So, he's a fiduciary. In that case, he wasn't.
Yeah.
So.
Yeah, I mean, you just have to be so careful because people toss that word around so lightly, and I'm glad people brought it, I guess, to the forefront years ago about learning about fiduciary status. I mean, shoot, you're a fiduciary on a trust, right? If you're settling an estate.
Right.
I mean, it's an important word, but at the end of the day, what is the ultimate philosophy of that person you're working with? Because, again, I think more and more people are going to become fiduciaries, but that doesn't mean that should be the end of your research and working with somebody.
I would say it is a prerequisite. If you're going to work with somebody, you probably want to make sure that they are a fiduciary, but that's definitely not enough.
Yeah. And I would definitely say, I mean, back to kind of tying in the accredited investor, be careful. Just because you are an accredited investor doesn't mean you should utilize those credentials at the end of the day to buy crappy products.
Which you don't know they're crappy or not, because in many cases they're not very transparent. So
yeah, it can definitely be rough long term. So long story short, be careful. And that's where I guess having a good financial planner like yourself is so important, because you don't sell anything. I mean, when somebody brings you the numbers on a product that somebody else is trying to sell them, you'll objectively break down the numbers. You'll talk to them about the risks. You'll tell them, hey, this is what it looks like if you want to do it. And ultimately, it's their decision to make. That is the job of a true financial planner, is to actually look at the situation, give people a number so that they can make a good, informed decision on how that impacts their financial plan.
And to really break down the actual numbers, because in many of those types of things, you might see numbers, but numbers can be misconstrued in a lot of different ways. Like, cap rates on real estate, cash flow, appreciation, financing levels, whatever it is. You can make numbers look however you want to. So, having somebody with no bias to say this is the cost and this is the benefit, does that make sense? Yes or no?
Yeah, and ultimately, you can't make the decision for people. It's still up to them. But again, you actually give them real numbers to work off so they can make a good, educated decision. And again, if you want a consultation with Harrison and learn more about his financial planning services, give us a call at the office here. It's 858-224-0004. Or again, you can contact us at the website, smartinvesting2000.com. With that, we'll jump back into the companies that we're looking at here. First one we're going to look at in the second part of the show here, we're going to look at Intuit. And Intuit, I know this is a company you like to use. We use it here as well. We use the QuickBooks portion of it. And I know you're a big TurboTax guy.
TurboTax. I use TurboTax. I have a lot of people that I work with that use TurboTax. I also have people that, have CPAs or enrolled agents or whatever it is, and that's fine too. But, I mean, I think TurboTax does just fine for some people, not everybody.
Yeah, and it looks like a lot of people are using TurboTax, and the shares.
I believe it.
the stock climbed nicely last week, about 8% actually, after the company reported a rosy full-year outlook for the upcoming year here, and Intuit expects adjusted earnings in the range of $20.07 to $20.12 per share, which was actually up from its previous guidance of about $19.16 to $19.36, and analysts were looking for about $19.40 in earnings per share. So, I mean, that was definitely a strong beat in terms of that outlook for Intuit. And again, I think a lot of it is, I mean, they have a great market share. I mean, their products are fantastic. I know we use the TurboTax, we use the QuickBooks.
I
and
like QuickBooks too. Yeah, QuickBooks is really easy to use.
It's amazing, especially if you're getting more small businesses. If you're getting that growth as an economy, I would assume this company would be a benefactor.
Yeah, it's very intuitive for Intuit.
I'm assuming maybe that's why they called it that, but I don't know why they call it Intuit. But anyways, let's look at the numbers here for Intuit. Their ticker symbol is INTU. They are in software application. Not much short there. It's about 1.4%. This is my concern with it. I hadn't looked at Intuit in a while, so I thought, hey, maybe it looks interesting. But price to earnings, 61.4 times. Very expensive there. Whoa. Industry's expensive too at 87.9. Even price to sales, 11.7%. That's above the industry of 7.3. Price to tangible book value, I don't know. I assume perhaps they've gone through a lot of acquisitions. Price to tangible book value, 238.6 times. Again, the tangible assets essentially on the balance sheet. And price to cash flow, obviously expensive as well at 34.2, above the industry average of 33.5. Reason why I think it's potentially expensive, the growth's been good. Over the last 1 year, earnings were up about 13.2%, sales were up 15%, But over the next 5 years, they're looking for earnings growth of about 17.6%. So, I mean, that is a good grower. The question is that valuation worth that growth rate?
That's an extremely high number, 61%. And I mean, I like Intuit, but how could they possibly be growing that much to grow into that? I mean, I've talked to people, and a lot of people. TurboTax is the standard as far as tax prep, but there's other ones out there, and I know that some people are shifting to those things for whatever reason. And I think if you're somebody who does TurboTax, you probably do it every single year. And every year that I've bought it, the price has pretty much been the same. So I know that they're not getting extra sales that way. So that means they've got to be getting new people, or they've got to be getting new business owners or something like that that are using their QuickBooks products.
Yeah, or they're expanding products. So I know sometimes on QuickBooks they have like, oh, you can, put cash in here in this QuickBooks account, which I've never wanted to do that. I feel like, we bank with Chase. I feel very safe with that. And especially with our business banking, I want to make sure that we have good safety, good liquidity. We can access that money as quick as possible. I'm not saying maybe QuickBooks has a bad bank account there, but I feel much safer with Chase at this point in time. But maybe to have ancillary services that they're starting to offer, that's one other way that they can continue to grow. But you're absolutely right. I think like Cash App, which is owned by Block or Squares, what the company used to be called, I believe they also offer tax planning or tax services, tax filing services online now as well.
Yeah, I know that there's a couple of them, Tax Act or something, Tax Slayer. I don't know. There's different names.
Slayer.
That might be not it. I don't know.
That'd be a good name. It'd be funny. But yeah, I mean, it's a great point about how is this company going to actually grow at that growth rate. If you own the stock, I haven't gotten the target sell price yet, but I'm going to assume it's going to be way overpriced. You'd want to know how this company is growing because you need that growth to justify that valuation so far. Kind of funny here, we talk about the low dividend for Regeneron. Same dividend yield for Intuit, 0.6%. They do have a higher payout ratio, though, at about 32.5% of earnings and 19.3% of free cash flow.
Makes sense with the super high PE ratio.
Yeah. And the thing with them, too, is they have the cash flow for it to even increase it further if they wanted. But again, if you have that high valuations and you're supposed to grow that much, returning capital to shareholders many times is questionable in my opinion because you're trading at such a high valuation. You need growth. Mm-hmm. Returning to shareholders might actually cost you long term if you can't then turn that money into growth. And I'm kind of surprised by this. They buy back about 1.1% of their shares over the last year.
Why?
I mean, trading at that valuation, it's like you should be looking, again, for external options for growth rather than buying your own stock at a valuation that high. Your hurdle rate's got to be immensely high to buy back your own stock.
Yeah, and it wasn't very much, 1.1%. I think you said not very much. But you're right. I mean, the dividend and the buying back shares, it seems like you would want all capital going to try and increase the revenue or branch into new markets or whatever it is.
Yeah, and I will say sometimes companies like this buy back their stock to offset stock-based compensation, so that could be a reason for that. But again, another thing you want to dig into, balance sheet for Intuit, very good. 1.5 is the current ratio, so plenty of liquidity. Debt to equity, 0.4, so not much debt on the balance sheet. Great profit margin here, 19.1%, above the industry of 10.9%. Current price for Intuit, $753.47. The 52-week low is $532.65, and the high here, $759.50. Year to date, the stock's been a great performer, up about 20.3%. Over the last 5 years, up 174%. Over the last 10 years, wow, up 677.5%. So, I mean, Congratulations if you've held into it. You've definitely done very well. The stock's been a great performer. As always, though, the question is, do you continue to hold it going forward? Because obviously, it might not do 677% going forward over the next 10 years.
Looking at the price to earnings, I would be shocked.
Yeah. And I was going to try and see here. I'm having some issues on the technology side to see what those future earnings are. I'm assuming they're not going to be great. Yeah, July 2026 estimated earnings per share is $22.86. I mean, that gives us a target sell price here of, trying to do some quick math, $379.48. I mean, forward PE is still over 33 times. And earnings growth, why we said is good. I mean, it's about 18% this year, 13% next year. I mean, there becomes a point where that earnings growth becomes so challenging that it becomes harder and harder to justify that high valuation on Intuit. So
I like the business, maybe expensive.
yeah, I agree with that. I continue to use the service, but I don't think I'd recommend the stock at these levels. It'd be one if it went on sale, I'd absolutely jump on it. I think it's a great company, but
Yeah, it's got to have. I mean, the cash flow is very consistent with them. If you use QuickBooks, you're not changing likely because it's a pain to change. And same with TurboTax. If you're used to it, you can buy it at Costco, you buy it on Amazon. It's very convenient.
yeah, and I think the hard part is with them, and I don't know the numbers exactly, but I think during tax season their revenue spikes, so it's almost like they'll find out if they had a good year in that one quarter. If they have a bad quarter, well, then their whole year is going to be bad. So you do have a little bit more, I'm going to call it timing risk, than most other businesses. I mean, I guess that's kind of true for retailers as well during the holiday season, but
for them, up until April 15th, that's got to be
that's what we got to crank out.
Yeah, that's going to make or break the year is how that goes.
All right. Well, next company we're going to take a look at here is another company that I'm going to say has actually struggled quite a bit, and that's going to be Target. And Target, they fell again after their earnings report. They actually missed first quarter revenue estimates and cut the full year sales outlook. Executives from Target, they blame tariff uncertainty, which is not surprising considering the current situation, weaker discretionary spending, and then kind of surprised by this, but backlash to the company's rollback of key diversity, equity, and inclusion efforts for its performance. So I don't know if the company's making excuses potentially for lower sales. I know other companies have kind of rolled back. DEI is also what that's known as, and they haven't seen the same decline in sales.
So they have backlash to rolling that back, or backlash to having it in the first place? Because I think they had backlash for having it in the first place, and now they have. Okay.
This is why I think companies got to be so careful with politics, because you piss off half the people. So then you pissed off half the people rolling it out. Now you're pissing off the other half of the people rolling it back.
Not worth it.
Oh
now
man!
Now everyone's mad. 100% of people are mad now.
And I was gonna say the other interesting thing with Target, before I get into the numbers, is I was kind of curious on this because obviously the tariffs are so impactful for the businesses currently. China is the one that worries me the most long term in terms of our back and forth and what long term tariffs might look at with China. And about 30% of Target's merchandise is actually sourced from China. So that could be a problem for their earnings, I'm going to say, over the next 6, 12, maybe even 18 months as we continue to, I'm going to say, fight with China, this trade war. This is a significant decrease, though. I was shocked by this number. This was scary if they were in this situation now. But back in 2017, about 60% of their merchandise came from China.
Where does it come from now?
They probably diversified to Vietnam, Cambodia, kind of those other Taiwan, different Asian countries over there.
Asia, yeah.
But either way, at least you're kind of diversifying that supply chain away from China. But again, 30%, that's still going to be quite impactful from Target. Yeah. Curious to see if they're going to try and amplify that shift away from China given the current tariffs. So that'll be something of interest to watch for Target as we progress. But looking at the current levels for Target, the price to earnings, the stock has been hit quite hard. So price to earnings is 10.3 below the industry average of 38.7. Price to sales at 0.4 below the industry at 1.2. Price to tangible book 2.9. Industry average 39.8. Price to cash flow 6.6. Industry average 21.3. You're looking for a 5-year estimated growth of 13.8, which gives you a nice PEG ratio of 0.9. Valuation's very strong here. Plus, you get a good dividend yield of about 4.8%. That's a real dividend, not 0.6%. Yeah. Company uses about 49% of their earnings to pay that out and about 58% of free cash flow to do so. So I'm not necessarily worried about that dividend. It's still pretty secure. Mm-hmm. Balance sheet for Target, current ratio 0.9, a little bit light. I'd like to say maybe a little bit higher, and debt to equity at 1.4, also a little bit high. So I'm going to say the balance sheet is okay. I wouldn't say it's overly strong. I wouldn't say it's weak. It wouldn't be a deterrent for me investing in this business. Net margin, obviously higher turnover business. It's about 3.8%. So they still make about 4 cents on every dollar of goods that they sell. And this is, again, where Target is interesting. The current price here, $94.01. The 52-week high, $167.40. And the low, $87.35. Year to date, the stock's down 29%. Over the last 1 year, down 34.1%. Over the last 5 years, you're down 10%. The 10-year return now is about 56%. So, over the last 10 years, I'm going to say you haven't done well with it. You haven't done bad, but a 56% return is not great over a 10-year period.
Over 10
and
years, no.
especially considering a lot of that lackluster performance has occurred over the last few years.
Yeah, so I'm sure if you looked at, years 1 through 8, it was probably
pretty good.
Yeah.
Yeah, and then if we go forward now to look at Target, January 2027, estimated earnings per share is $7.99. Actually gives us a target sell price of $132.63. So it trades under 12 times earnings, which it would place in the buy category. One thing that's always concerned me with Target, though, I get a little bit scared buying businesses that essentially don't own the brand because they could be displaced. And it's hard. I mean, they're competing against Costco. People love Costco. Competing against Walmart, which Walmart's been a very strong competitor over time. Can Target put themselves in that category of a Walmart, of a Costco? A little bit different than a Costco because of the membership. But again, you're still competing for that retail business at the end of the day. And I'm not sure. I mean, it scares me a little bit from that perspective.
The thing that scares me is the uncertainty around the tariffs and how much they have coming from China. I mean, that seems like that could result in a lot of volatility. And I'm sure that's contributed to what's happened with the stock price, and that's why it looks a little bit more attractive at these levels. So it'll be interesting to see how this evolves over the rest of this year.
And I do think this is interesting as well, but just kind of like in the market cap, because I'd say most people would say Target and Walmart are quite comparable. Target's market cap is now around $43 billion. Walmart's is $776 billion. I mean, it's
like
huge discrepancy.
5% of Walmart. Is that the math?
Yeah. Well, I just know that Walmart also is very expensive. So I mean, it's not obviously Walmart. Yeah. I think trades something crazy now, around like 40 times, 50 times earnings. So you're getting 5 times essentially the multiple on it. The earnings and sales might be more comparable than the market cap, but the valuation is a huge difference. And what surprised me too, I saw this the other day, is TJX. They own Home Goods and what's the other big one?
Marshalls.
Marshalls. Yeah, I think they own Marshalls.
Yeah, the credit card.
Is TJ Maxx is the other
Maxx.
one.
I think Marshalls is in that too.
But their market cap about $141 billion. So
really?
$100 billion more essentially than Target, which I would say Target would probably be bigger, but they're not. So, I have mixed feelings. I want to say Target's a good maybe. I think there's some potential there. You get a good dividend, good valuation, but there's some definite question marks around, I'm going to say, the longevity of the business and also, too, as you said, the tariffs. All right, last company we're going to dive into here, too, is Toll Brothers. They are a home builder. They also did report earnings last week. They had a nice report here. They had $3.50 in earnings per share on $2.74 billion in revenue. That beat estimates of earnings per share of $2.83, and then revenue was looking at $248. So again, a nice quarter for Toll Brothers. People are definitely still, as we talked about, buying houses out there.
Toll Brothers, they build houses. Toll House makes cookies.
Yep. Very different.
Switch names.
Very different margins, very different price points. And one thing, too, that shocked me about home builders, kind of talking about the real estate market, is right now, the median price of a new home is currently less than 1% higher than the median price of existing properties. Historically, there's been about a 17% premium.
That, I think, is so important because that, I think, skews the data on, there being a larger amount of supply of housing on the market. Yeah. Yes, there is supply, but it's not for the people that are buying homes or trying to get into homes. Since that premium is basically flat, whether you're buying a newly built home or you're buying a home that somebody else is selling, they're basically the same cost. Usually there's a 17% premium. Yeah. That's I think very interesting. Yeah,
and it's something that they're kind of having to succumb to, buying down interest rates. Like, I was kind of surprised by this, but right now the 30-year, it was around 7%. I say right now. Earlier it was around 7%, and at that time, home builders were able to buy down the rate to around 5%. So not only are the home prices similar, I mean, it's really pushing people that are looking at buying homes to maybe new homes because the cost differential isn't that great. Plus, you get a lower mortgage rate.
I think that I've had a bunch of clients that have come into things like that, and I think it's so interesting because if I was buying a house, which I have bought a house, but if I was buying a new house, I would not want the builder to apply the money that I'm paying for that house to buy down the rate. I'd rather just buy.
Because you can adjust it down the road.
Yeah, because you can refinance. Yeah. So why, at the end of the day, the builder is buying down the rate, but who's paying the builder? The buyer. Yeah. So I know that's going on a lot, and I I don't agree with it. I think it's dumb.
Well, let me give you some numbers here on Toll Brothers real quick. Price to earnings, 7.8. That's below the industry of 9.5. Also, too, we look at price to cash flow. That's 11.9. I'm going to jump to the balance sheet since we're running low on time. Current ratio, 4.2. Debt to equity is 0.4. Balance sheet's very strange for home builders. But looking at the current price here is $104.25, 52-week high, $169.52, and a low $86.67. See, year-to-date, the stock is down about 16.9%, but again, a 5-year return, 242%. So home builders, they've been on fire, and the hard part with these is valuing them. Because you go out to October 2026, estimated earnings per share here, $14.42. I mean, it gives you a target sell of $239.37. Forward PEs under 7.5 times, but this is such a cyclical industry, and our home builder is going to start running into more and more issues where those margins get further compressed, and now it justifies that valuation. So, interesting company. I'd say be careful of it. But thank you for joining us for the Smart Investing Show today. It is for informational purposes only and should not be used as investment advice. If you are looking for more financial information, be sure to check out our newsletter. You can sign up for that by going to smartinvesting2000.com or check us out on YouTube. You go to the Smart Investing Show, find some other great content there as well. Thanks again for joining us. We will be back here at the Smart Investing Show next week.